Alright, gang, it's your boy Nature, aka Nature. You already know what time it is. Another video. Alright, so we just went over the bounce. Alright, the bounce strategy. So we have to go over the break strategy. Okay, it's the bounce strategy and we got the break strategy. Alright, so the difference between the bounce strategy and the break strategy, the bounce strategy, you will simply wait to buy and sell. You wouldn't buy off the bat. You wouldn't buy right off the bat. You will wait for price to make a bounce or retest before entering. Okay? By doing this, you avoid those moments where price moves so fast that it slices through supports and resistance levels like a knife slicing through warm butter. On the other hand, as for trading the break, there is aggressive way and a conservative way. The conservative way is to trade during the bounce, during the retest. The aggressive way is to trade is during the break. So in the aggressive way, you simply buy or sell whenever price passes through a support or resistance zone with ease. Whenever it breaks through a support or resistance, that's when you get in. And you do it aggressively. That's why it's called the break. So it's two ways you can trade. The aggressive way of trading is called the break, and you wait to get in as soon as you see price break through a support or resistance level. Okay, conservative way, once again, is to wait for price to make a bounce or a pullback to a broken resistance or so. And once it makes that that pullback or that bounce back to that resistance or support level before going back in the direction that was continuing to go, that's when you get in. So conservative way the trading is the bounce. You wait for a bounce off of support or resistance. The aggressive way is to trade and it's called a break, and you break as soon as the trade breaks through the support or resistance with ease. Alright, so we're going to dive in more. Give y'all some examples, illustrations of what a breakout is in the market, in the Forex market, and what that means. So a breakout is potential trading opportunity that occurs when asset price moves above a resistance level or moves below a support level in an increased value. So with ease. Okay, so this is also the examples. Let me show y'all some examples also. Alright, so let's show you guys what an example is of a break strategy, so you'll be familiar when it comes to trading a break in the Forex market. So there are dozens of breakout strategies available to traders, but the Forex breakout strategy you're about to learn is my personal favorite. This strategy has been responsible for some of my largest gains over the years. In this lesson, I will teach you and you will learn how to identify the setups, when to enter the market, as well as how to identify possible targets. We will also take a look at several examples on both the 4-hour chart as well as the daily chart. I have found these two time frames to work out best when trading the breakout strategy. Yes, when trading the breakout strategy, is best to look at the 4-hour and the daily chart to trade the breakout strategy. When it comes to the bounce strategy, it's better to use the 15-minute chart, the 5-minute chart. So, what is a breakout? Before we get into my favorite Forex breakout strategy, let's first define the term breakout. A breakout is a price movement outside of a defined support or resistance area. So the breakout can occur at a horizontal level or a diagonal level depending on the price action pattern. Let's take a look at the two illustrations of one of them more common breakout patterns that occur in Forex market. The first illustration shown is a bullish breakout pattern. Okay, so bullish means up. So this is a bullish breakout pattern. Okay, you can see that it finally broke out out of the box. It finally broke out of the what is called like a triangle or a flag pattern. It finally broke out of the pattern and going up. So it's a bullish breakout. So notice in this illustration above, we have the market that is trending up. So it's an uptrend, but it has found some resistance at levels. So the top will be the resistance, and the bottom will be the support. So at the top, it found some resistance. Okay, it finally broke that resistance level. It finally broke out of that resistance level. Okay, the resistance is the top. It finally broke out of the resistance. Okay, then the market finally breaks through the resistance to signal a bullish breakout from a key resistance level. So once it broke that key resistance level, it finally broke out and made a bullish breakout. So the next illustration we're going to look at involves a bearish breakout. So same thing, this bearish means a downtrend, it means down. So this is a bearish breakout, it's a downtrend breakout. So a bearish breakout, resistance will be the top and the support will be the bottom. So in this illustration, you will expect the bearish breakout is similar to the bullish breakout. However, only this time the market breaks down to the downside. After two unsuccessful attempts, the market finally breaks through their support. This signals a bearish breakout from a key support level. So once it broke out of the key support level, it made a bearish breakout. So it's important to understand. I wanted to show y'all what a bullish and a bearish breakout looks like. So this is a bullish breakout. Once it breaks out of the resistance level and continues going up, it's called a bullish breakout. Once it breaks below and breaks down below the support level, it's called a bearish breakout. So this is the reason these breakouts are such an important trading strategy, because they often represent the start of an increased vitality. By waiting for the break of a key level, you can get vitality in other favors by joining the trend as it begins. So the only Forex breakout strategy you'll ever need. This particular Forex breakout strategy is one I have used for years. It has become my favorite pattern to trade, partly because of its reliability, partly because it's more than favorable risk to reward ratio is often produced. So there are four parts to the Forex breakout pattern. So the first part is to identify the resistance and the support. So resistance is the top and support is the bottom. So resistance, support, there's four parts. The resistance support is number one. The resistance number two. The breakout is number three. To identify, there's four parts to identifying the breakout. We must find the support, we must find the resistance, we must find a breakout, and then there's the retest. Once it breaks out of a resistance level or a support level, it will always retest to that resistance or support level it just broke out of before going back up. It's called the bounce. Once it retests or makes the bounce, that's when you get in. Or you could be aggressive and just get in once you see the break. But it's always going to bounce back. It's always going to retest back before going straight back up. Depending on how much money you have in your account, some people are aggressive and they can just, since their account size and their account size, they have more money in their account, then they can, last and risk more than someone that's trying to be conservative and just wait for the bounce to get back in. So this illustration above is very similar to the first two illustrations. The major difference here is instead of having one trend line and one horizontal line, we have two trend lines. One trend line is acting as support, and the other trend line is acting as the resistance. This form is known as the wedge. Okay, you see how it's wedging and wedging smaller and smaller and smaller before it breaks out? Okay, this is known as the wedge. The breakout to this pattern occurs when the market eventually breaks to one side or the other. While a wedge is typically continuing pattern, the breakout to this pattern occurs when the market eventually breaks to one side or the other, while the wedge is typically a continuation pattern or consolidation pattern. Once it tends to trade is based on whichever way the market breaks. So whichever way it breaks out is the way the market is going to most likely continue. So I tend to trade based on whichever way the market breaks. In other words, let the market show its hand before making any consideration about future price momentum. So yeah, if we have to wait to, for more confirmation, bullish confirmation, or a bearish confirmation before we enter and get in, for future price momentum or movements, or buy or sell orders. So now let's look and apply the same pattern to the U.S. Japanese yen on a 4-hour chart. So this is the U.S., which is also a major pair. Any of the USD pairs are major pairs. USD Japanese is very volatile though. It's more volatile because compared to Euro, it's still a major pair, but it's a little more volatile than Euro, Great Britain, Aussie, and you can say like France. You can throw France in there, Great Britain, Euro, Aussie. Meaning like it moves a little faster. USD, JPY, but that's more like an advanced session where I'm gonna be explaining, what pairs to use and stuff, and what pairs I think you guys should stick to. So for this example, this is the USD JPY on the 4-hour. As you can see, here's our resistance. Here's our support. It finally breaks out right here. As you can see, it broke out. Then it had retested right here at the top before breaking out and continuing that direction. So notice how in this chart above, the market has worked in this way in a wedge pattern. Made the wedge pattern too. As the market begins to consolidate tighter and tighter, it eventually breaks through the wedge and support. And for example, is breaking down, so it breaks past the support because the bottom is the support. If it was breaking up, it will break past the resistance. But in this example, it broke past the support and retested the support level as a new resistance. So that new support now is the resistance. So to retest the presented trader with a perfect opportunity to enter a short. This retest presents traders with a perfect opportunity to enter for short once you get the retest. So executing the Forex breakout strategy, to get a good idea of this setup in action, let's take a look at each step, including the entry strategy and where to place your stop loss. So as far as your entry strategy, most time your entries will come on a retest of a former support or resistance. So however, it is important, so a retest will come after a retest. An entry will come, these sniper entries that I was talking about. I'm going to teach y'all more and more. Most of your entries will come after a bounce or a retest off that support or resistance. After it breaks that support or resistance, it always has to retest or bounce back before going in that direction again. So however, it's important to note that depending on how strong or weak the market is, you may not get a retest. Sometimes you don't get a retest in this market, in this game. Sometimes it's just a clear trend, a clear uptrend or downtrend. So that's important to know too. We will discuss that in greater detail later on in this lesson. For now, just know that the best practice to enter on a retest or a former support or resistance, depending on which way the market breaks. Okay, so that's the best way to enter, is off of retest, off of a former support or resistance, depending on which way the market breaks. As far as your stop loss, it should be placed above or below the breakout candle at a minimum. In case of for the USD JPY breakout pattern below, your stop above the candle that broke the support. So in this example right here, your stop loss needs to be above the breakout candle. So okay, here's the wedge. It finally broke out of the wedge. The breakout candles right here to show you it made a bearish engulfing pattern. Okay, this candle is engulfing the other candle. Once it did that, and it broke out of that support key level was on. You put your stop loss above that breakout candle. and you enter short here. Okay, so this example in this chart above, the market broke wedge support. It broke the market broke the wedge support and on a breakout candle, as you see, it made the breakout candle. And subsequently, it retests the former support, as it always will. It's going to always bounce back to that support. After it breaks out of that support, it's going to retest that support, and now that is now that's a new resistance. And this every time it breaks out of support, it's a new resistance. Every time it breaks out of resistance, it's a new support. So this retest breaks out of it retest it was going to break out of the support level, then it's going to retest that support level. Then that new support level is now the resistance, because the top now is, because it's a downtrend, but the top now, that last top before breaking out, is now becoming resistance. Okay, top is the resistance, the bottom is the floor. So it retests that, presents the opportunity. Once that retest happens, once it retests that support level, it presents an opportunity for you to get in for a short position, or for a sell position. Short means sell. It gives you that opportunity to get in for a sell position. You put your stop loss above the breakout candle, okay, and you're good. We're in the trade. So setting up a target. So now that we know where to enter and where to place our stop loss at in the trade, let's discuss how to set up a target. So as you may well know, I'm a huge fan of using simple price action levels. So you can probably guess how we're going to go about setting this profit target. So here is a much broader look at the USD JPY charts. This time we're looking at the daily time frame to see where we can identify a local target for our breakout trades. So alright, let's go down to USD JPY chart to see where we would get in to identify a breakout trade. So it's consolidating. It finally breaks out of consolidation. Right here, makes a little breakout candle. You want to enter the trade. Boom. You want to exit the trade right here. Once it makes that doji, right here at the bottom, trade. Okay, because it's going back up now. So we exit the trade once it makes that. So first thing you notice is the strong support area. You see the blue highlight lines. Those are support levels, support areas where the market went to. Remember, the support is the bottom, resistance the top. So it was a strong support area that had been placed here for several months. This makes for an ideal area to target for our trade setups. So what kind of risk to reward ratio did we get out of this trade setup? Let's take a look. So, all right, your stop loss is above breakout candle. Breakout candles right here. Put your stop loss above the breakout candle. Here's an example. They put 13 pips. I usually say 20 pips. 20 pips. Some people might say 50 pips for your stop loss after it makes the breakout candle. Make the breakout candle. You enter once it makes the breakout candle. Boom, it hits your take profit for 50 pips. You make a quick 50 pip take profit. Boom, you exit out the trade. Okay, so what kind of risk to reward ratio did we get out of this trade setup? Let's take a look. So in the USD JPY 4-hour chart above, you can see that the stop loss was 13 pips from the entry, where the take profit was, and 50 pips from the entry. And then we got 50 pips from that entry. The take profit was 50 pips from the entry that we got in. So to give us a 3.8 risk reward ratio. So it's 3.8 risk ratio. In other words, if you had just risked 2% of your trade, you have made 7.6%, because 3.8 risk reward ratio times 2% of your trade will give you a maximize of 7.6% that you just made in that trade. Okay, so while this is an impressive game on its own, what's even more impressive is the fact that we would have made 7.6% in just 32 hours. Okay, and this has happened in 32 hours. Okay, so further analysts has turned our attention to another example of a Forex breakout strategy. This wedge pattern occurs on the GP NUD chart, Great Britain, New Zealand chart, 4-hour chart. One major difference here is that there was no retest of former support once the market broke to the downside. So once the market broke to the downside, it didn't retest, it just broke to the downside. And that happens sometimes. Sometimes you won't get a retest. Sometimes the market will just be what it is, will just be a downtrend or uptrend. So notice the GP NUD chart above the market failed to retest the former support before dropping to 430 pips below. But just because the market doesn't retest the former support doesn't mean we have to miss that trade. Okay, so sometimes we don't retest, you can just get in that trade. So the retest that we look for as a part of this Forex breakout strategy typically comes within the next few candles. So if the market begins to move sideways for more than 3 or 4 periods, there's a good chance that the market won't give a full retest. Let's take a closer look at GP and NUD trade setup. So as you can see, it was in the last 4 periods, it was consolidated, breaking out before breaking down to the downside. So in the GP NUD 4-hour chart above, notice how the market begins to move sideways for several periods. This is a good indication that the market lacks the strength to retest a former wedge support. When you see this happen, it generally is a good time to use a market order. Like I said, you learn about market orders, buy orders, sell orders to join the forthcoming trend. Here is the GP NUD breakout trade from start to finish. So this is what happens from start to finish. You put your stop loss. You put a stop loss 45 pips above the breakout candles right here. As you can see, breakout candle, boom, it finally broke out of the wedge, boom, to the downside. We put an entry. We enter as soon as it breaks out, or as soon as it retests. Once it breaks out and it retests, then we enter for 175 pips, take profit. Okay, so for this setup, our stop loss was 45 pips from the entry. Remember that you want your stop loss above or below the breakout candle. So for this example, it's going to be above because it's breaking out on the bottom. Okay, so because this is a setup, our stop loss was placed above the breakout candle. Because it's a short position, a short setup or a sell setup, our stop loss is placed above the last breakout candle. As you can see in the example one more time, we enter, get 175 pips, take profit, boom, we exit the trade, 175 pips, take profit. Our take profit on the other hand was 175 pips from the entry. The target was identified by the recent low, which was made several weeks prior. Note that the market gapped down the following week and ran for another 150 pips before reversing. It did. It ran down for another 150 pips before reversing back up. That usually happens sometimes. When that does happen, great hindsight, the logical target at the time was 175 pips, which would produce a very healthy 3 to 9 reward ratio trade. So you, mind you, we only risk 2% of our trade, so you have risked 2% of your trade on this trade, and you would have been left with a profit of 7.8. This particular setup took just about 36 hours from start to finish. Not bad to be able to make 70.8 profit in 36 hours while only risking 2%. So Forex breakout strategy, the real potential. As I bring this lesson to a close, I want to leave you with one last setup. The particular breakout occurs on the USD JPY daily chart. It represents what's possible with the Forex breakout strategy you learned today. So okay, made the wedge, made away from our resistance and our support. It finally broke out. Okay, boom. As soon as it broke out, we put our stop loss below, 50 pips below, and we enter once it makes that breakout or once it makes that retest for a profit gain of 600 pips. Okay, take profit. The first thing you notice is the length of the time the market consolidated within the wedge pattern before breaking higher. The setup above forms a daily chart. This is on the daily chart. So from the start to finish, the consolidation period lasts for 180 days. Okay, from start to finish before it broke out to 600 pips. During this time, this brings me to an important observation about the Forex breakout strategy. The longer the market consolidates, the more the breakout will be. The more money, the more you will have once it breaks out. This isn't always the case, but 9 out of 10 times the market will respect this idea of matching the length of the consolidation to the level of vitality. So for those who were able to get in this trade at the breakout point and ride the trade into the consolidation period, you ride this trade into a consolidation period has occurred, your take profit level, there was a massive gain to be had. A stop loss below the breakout candle meant about 50 pip stops with a potential gain of 600 pips. That works out to be very healthy 12 risk reward trade. So at just 2%, we trade 2% of our trade with a risk of 12 reward ratio. 12 times 2 times 12 will give you a profit, making a staggering profit of 24% in profit. So you got 24% in profit. Although this is rare, these 10 reward ratio, these 12 reward ratio trades, or even 8 reward ratio trades do happen from time to time. With the knowledge that you have gained in this lesson, you'll be able to identify and profit from these patterns with ease. So to sum it all up, the summary, I hope this lesson has opened your eyes to what's possible in simple Forex breakout strategy. Just remember that like any other trading strategy, this breakout strategy is not without flaw. So always be sure to maintain a proper risk to reward ratio. Do not over leverage your account, only use about 2%, especially when you're starting off in trading. It's proper to use reward ratio and use a favorable stop loss strategy on every trade. Always have your stop loss strategy on every trade just in case it makes a fake out. And what a fake out is too, when you think it's breaking out and it's going in that direction, and then price winds up going all the way back up in the opposite direction. And that happens. When that happens, it's called a fake out. We cover a lot of content in this lesson. Here's some of the highlights to keep in mind as you begin to implement this trading strategy into your game plan. A breakout is a price movement outside a defined support or resistance area. So breakout is when price moves outside a defined once it breaks out of support or a resistance area. That's called a breakout. So Forex breakout strategies have 4 parts to it. You have to find the support, you have to find the resistance, you got to find out when it's going to break out, and you have to find out when it's going to retest. Those are the 4 parts to a breakout strategy: the support, the resistance, the breakout, and the retest. The retest of a form of support or resistance level, so it's going to retest or bounce back to a support or resistance level prior to where it broke out of, and then that provides traders, the market does that because it retests, it bounces back. Sometimes it doesn't, sometimes it just goes straight up, it goes straight down. Or a bounce back to provide traders an opportunity to enter the market. So you wait for that bounce back. Once out that breakout, you wait for that retest. If the market begins to move sideways for more than 3 or 4 periods following a breakout, there's a good chance that the market won't produce a retest of a former support or resistance. Okay? Meaning like once it starts to consolidate and then it breaks out, there's a good chance that it won't retest or that support and resistance once it breaks out. Sometimes there's a good chance that doesn't happen. I just explained that. But remember, you put your stop loss should always be placed above or below that breakout candle. So remember that breakout candle, your stop loss needs to be placed above or below, depending if it breaks out. If it breaks out above, then your stop loss is going to be placed below. If it breaks out below, then your stop loss is going to be placed above, depending on which way the market breaks. It's best practice you use. It's price action levels to identify potential targets for this breakout strategy. Okay, so we had to look at price action levels. We're also going to study price action levels too. For this breakout strategy to work, a good place to start is at a recent swing high or low. So it's better to start at the bottom or the top, okay, to identify a breakout strategy, As general rules, the longer a market consolidates, the more volatile the breakout will be. Okay, the more bigger or longer the breakout will be. So frequently asked questions: what is the best breakout strategy? Something simple like a wedge or a channel break is my preferred method for trading a breakout. Just keep in mind when you trade a wedge, when you make a wedge, you need to have two trend lines. You need to have one for your support and one for your resistance. Keep in mind also that there are no two traders that are alike. Okay, which means that this strategy, that's best strategy for me, might not be the best strategy for you. Okay, but it works. You know what I'm saying? Which means that the best strategy is the one that works best for you. Whatever strategy works for you. Because there's no trader that's alike. Everybody's not alike. So whatever works out for you, it will work out for you. So our breakout strategies are reliable. Absolutely. As long as you take the time to develop a trading edge and a trading strategy and stay patient, a breakout strategy, like the one I just taught you here, can be reliable and can be incredibly profitable. What is the best time frame to trade a breakout? Subjectively, but I have to found that it's subjective, but I have found that the 4 hour and the daily time frame is the best time to perform when trading the breakouts. I agree too. You want to look at the 4 hour, the daily, even the weekly when it comes to trading a breakout. When it comes to trading a bounce, I would say more the 15 and 5 minute. Do you need indicators to trade breakouts? Price action is all you need. That's why we're going to go over price action again. Price action really is all you need. Resistance, support level is considered price action too. Some will argue that, and that's okay. Because no two traders are alike. But in my experience, nothing beats raw price action for trading breaks. So, your turn. Do you use this similar Forex breakout strategy, or maybe you just have questions about this lesson? Either way, I'd love to hear that from you. Alright, so this is how you create a breakout. Breakout strategy. Let's also look at one more example real fast. Breakout strategy. Breakout trading usually is you trade early stages. Generally speaking, this strategy can be the starting point for major price moves, expansion, and volatility. And when managing properties, can offer limit downside risk. Throughout this article, we will walk through the anatomy of trade and offering strategy. So a breakout is a potential trading opportunity that occurs when an asset price moves above a resistance level or moves below a support on increasing volume. The first step in trading a breakout is to identify the current price trend patterns with the support and resistance level in order to plan possible entries and exit points. Once you act on a breakout strategy, know when to cut your losses and reassess the situation if the breakout splurs. As with any technical trading strategies, don't let emotions get the best of you. Stick with your get in and when to get out. So, what is a breakout? A breakout is a stock price moving outside of a divine support or resistance level with increased volume. So that's a breakout is when stock or when price moves outside of the support or resistance level with increased volume. A breakout trader enters a long position after a stock breaks above a resistance, after it breaks out of above resistance, and they enter a short position after price breaks below a support position. Once the stock trades beyond the price barrier, volatility tends to increase the price usually and trend in the breakout direction. The reason the breakout are such an important trading strategies because these setups are the starting point for future volatile expansions, many price trends. and major trends. Breakouts occur in types of market environments. Typically, the most explosive price movements are results of channels, breakouts, price pattern breakouts, such as triangles, flags, and head and shoulder patterns. As a vitality contract during these time frames is typically expands after price moves beyond the identified range. So this is an example of a bullish breakout. Okay, you see it's going up. Bullish means going up. It broke up. So it wants to break out. It's called a bullish breakout. Regardless of the time frame, a breakout trading is a great strategy wherever you use, even on an entry, a daily, a weekly, a scraping strategy. The concepts are universal. So you can apply the strategy to day trading, swing trading, or any trading breakouts. It's important to consider, you know, your Forex or stock supports and resistance level first. You know, the more times a stock and price has touched these areas, or the price has touched these areas, the more valid these levels are, and the more important they become. At the same time, the longer these support and resistance levels are touched and played with, the better the outcome when it stops, or the price starts to finally break out. So in this example, it finally breaks out and it makes a bullish breakout. This is a bullish, means going down, so it makes a bullish breakout. Once it makes a bullish breakout, you see as price was consolidating, various times price is consolidating, price patterns will occur over the price changes. For formations such as a channel, it makes a channel formation. Once it makes a triangle flag formation, which is basically just identifying, you know, a support line and a resistance line. Once it does that, we get in for the trade. Once it breaks out of that flag or triangle pattern. So aside from the pattern, consistency and the length of time and the price, the stop price or the price has occurred. Two, support and resistance level is an important factor to consider when finding a good candidate to trade. So entering prior instrument to trade is the time to plan the trade. The easiest consideration is to enter point. Entry points are fairly black and white when it comes to establishing positions on a breakout. Once price are set to close, I'm on the phone, bro. I'm recording. Once price are set to close above a resistance level, an investor will establish a bullish position. When price are set to close below a support level, an investor will take on a bearish position. So, entry points. After to trade, it is important to plan a trade. The duration is on an entry point is to fairly but to establish positions on a breakout. Once the price are set to close above a resistance level, you get in for a bullish position. When price sets below a support level, you get in for a bearish position. So determine there's a few things I want y'all to know before I close this. Determine the difference between a breakout and a fake out. A breakout and a fake out. So wait for confirmation. For example, a fake out occurs when price opens beyond a support and resistance level, so it breaks out beyond a support and resistance level. But by the end of the day, it winds up moving back to the prior trading range, which is called a fake out because it moves right back to the prior trading range. It goes right back to the support and resistance level. So it's a fake out because price was supposed to break through. But if sometimes this actually occurs a lot, it's called a fake out. So investors act too quickly. They got in too quickly without confirmation. There was no guarantee that price will continue it, and that by the end of the day, price came back to the closing period and where it was before it broke out. And this is called a fake out. The price wasn't sustained, the level wasn't sustained, and it broke back up. It made a fake out. So planning exits. Predetermined exits are essentially to successfully trading approach. Predetermined exits are essentially ingredients to successful trading approach. When trading breakouts, there are 3 exit plans to arrange prior to establishing a position. Where to exit when a profit. When planning a target price, look at the recent behavior to determine reasonable objectives. When trading price patterns to to look at the recent price action. We're going to go over price action and price targeting for examples to wish to determine where the breakout is going to occur. So another idea to this is another example, another illustration of price action, and what we be doing how we make a price target off of this. So as you can see, it's making swing highs and swing lows, back and forth, back and forth. It's consolidating. It's making swing highs and swing lows, back and forth. Then eventually it breaks out below. Over the past, it was swinging up and back for the 4 points over the past few price swings. This will be a reasonable objective. These are a few ideas on how to set price targets as trade objectives. This should be your goal for trades. After the goal is reached, an investor can exit the portion of the position to let the rest run. You put a stop loss in. You could take a portion of your position, portion of your money, and you could let the rest of the trade run out, or you could just put a stop loss order in and lock in all your profits. So where to exit with a loss? It's important to know when a trade has failed or made a breakout or made a fake out, and when to exit off a loss. So after a breakout of an old resistance level, it should act as a new support, or old support level should act as a new resistance. This is important consideration because it's an objective way to determine when a trade has failed and the easiest way to determine where to set your stop loss order. As the position has been taken, use the old support and resistance level in this line and close out the losing trade to close out a losing trade. As an example, study the PCG chart below. So this is the PCG chart that they just made for this illustration. As you can see, it was a fake out. It failed to break out. It was supposed to break all the way down, but it didn't. It faked out and it went back up to where it broke out eventually. Okay. If you don't know that though, you will be making and losing a lot of money in this trade. So after the trade fails, that's why I say it's important. I would just have got out the trade once it started making higher lows and higher highs. So we just got out the trade and just took that take profit. In this example, they didn't get out the trade. They stayed in the trade because they thought it was still going down. The trade wanted being a fake out, wanted going back up. It's important to exit that trade quickly. Never give a loss too much room. If you are not careful, losses can accumulate. So when to set your stop order. When to considering an exit position with a loss or using price support resistance level beyond which price has varies, a safe way to protect a position without giving two trades much downside risk. Setting a stop higher than will likely trigger an exit prematurely because it's common for price to retest price level that they've broken out of. So don't push your stop loss too close because price will always retest. So you don't want to push your stop loss too close. That's why they say put about 20 pips to 50 pips from wherever you enter it at. So looking at this above chart, you can see the initial consolidation price period as it broke out and retested, and price objectively reached out, it faked out, and it went back to the old resistance level it was at. This immediately stop out. If you put your stop loss above and it went back, then it closed you out the trade. So this is why I say 50 to 20 pips where you put your stop loss at. So setting your stop below this level too early allows price to retest and catch the trade quickly. And when you put your stop loss in, it allows price to catch that retest in case price does whatever it wants, and then so you won't lose so much money in the trade. It stops you out quickly. When you put that stop loss. So in summary, here are the steps to follow when trading a breakout. You want to identify the support, the resistance. The stronger the support or resistance, the bigger the outcome of when it breaks out. Wait for the breakout. Finding a good candidate does not mean a trade should be premature for a price to move and break out. Once it breaks out that trade, on a day, once it breaks out that trade, then you get in. Depending if it breaks out of support or resistance level, you get in and you wait until the end of the day, around 5 o'clock, 4 o'clock, that's when the market closes. You wait till the end of the day, then you get out the trade. Okay, that's like more day trading. It's more advanced sessions that we're going to be talking later on. But number 3, if you are going to trade, set in a special set, exponentially where it's going. If you don't know where to exit the trade, this could be calculated by the moving average. It teach you how to exit the trade more and more. Also allow the trade to retest before getting in the trade. That's the conservative way to do is to wait for the trade to retest that resistance level or support level before getting in that trade. Okay, so before getting in that trade, sometimes you could do the aggressive trader and just get in as soon as it breaks out of that support and resistance level too. If you can risk your money and stuff like that, and you have enough money to take that risk, then okay, you can do that. So know when trade patterns have failed. Know when you have took a loss. Don't gamble with your losses. Okay, just take that loss. You know what I'm saying? Recalculate your strategy. And get back in the trade. Okay, so and the last thing would be to exit the trade. Exit the trade. Take your profit. Okay, and because the market can do whatever it wants to do. So exit your trade, take your profit. Once it hits your take profit, take your profit, and exit that trade. And we're going to look for more positions, and more trades after that. And be patient. The strategy requires plenty of patience. So by following these steps, you will reduce your emotions, and you'll be objective about your trades. So exit your trades. If you're not going to exit trades with a loss, if you're not exiting your trades with losses, then you are in the trade. Okay, so if you're not losing, then you're in the trade. Make sure you stay in that trade. You should remain in the trade until stop price reaches your objective or your take profit or your strategy, your take profit strategy. Once it reaches your goal, then you get out the trade. Okay, so be patient and wait for it to reach your goal with before getting out that trade and exiting out that trade. So the bottom line, breakout trading welcomes vitality. Vitality experience after a breakout is likely to generate emotions because prices are moving quickly. Using the steps to cover this article will help you to define a trading plan that will properly work for you, because everybody's different. So find these, just play with it, and find out what's best works for you. So you can offer your risk. Okay, so again, this is how you trade. This is a breakout strategy. What is a breakout strategy? This is the breakout strategy. All right, gang. So I hope this helped. Gang.